on the CNBC Newsline. Always good to talk to you on a Friday, Art. How are you feeling about the bank crisis and potential for more pain?
Well, I think first let me say that the viewers want to be very, very careful. A Friday like this is a rumor monger's delight, and we are on the edge of what we were doing back when Lehman got in trouble. You may recall they were buying the credit default swaps, and they were buying out-of-the-money options, out-of-the-money puts, and then compounding it by spreading the word on Twitter and elsewhere that, did you see that? Somebody just bought a put 20% below the current price. So the viewers have to be very, very careful about what's going on. Now, what happened over this last week came as a shock to the Fed and everybody else. And the reason that they implicitly had to guarantee was that we were actually on the verge of a rerun of the panic of 1907, the actual panic that caused the Fed to be established. And I believe that there are folks running around. I would love to see what the credit default swaps are doing, running around and getting a list of the banks and seeing who has the largest percentage of uninsured deposits, and then kind of bringing that to everybody's attention to see if you can tip over the bank. So that's the kind of backdrop that you've got here, and that's why you're not necessarily seeing people look directly at the economic news. This is fully captivating. You know, we had all these people a week ago were running around with the word idiosyncratic like it was a new baby toy, and assuring us that there was nothing systemic about it. It is systemic. The Fed has forced many of these banks to reconfigure their portfolios. So as Sarah alluded to, they are having duration risk. And that's been around before. You guys should call up or interview Chris Whalen. He wrote back in February 27th that the Fed was forcing people into duration risk, and he singled out SVB. And sure enough, it all came down. So this is not unknown. And then finally, you know, everybody's talking about new regulation. I think this is a failure of supervision rather than regulation. I think the bulk of the regulation is there. And, you know, where were the people who noticed that they didn't have a risk officer at SVB? Where were the bank examiners to notice that the duration of the portfolio was misaligned? So today's a good day to be careful. Friday before a weekend, financial rumors around. So the viewers have to be careful to avoid rumor mongers.
Hey, Art, just quickly, what's your read on how the overall market has been able to actually stand up to a lot of these concerns this week and at least kind of hang in there in the middle of this range?
Well, it has been impressive, but you know what I've noticed is that, you know, we've zigzagged two extremes. So the market goes from oversold, which then allows for quick bounces, and that stabilizes everything, to almost overbought with that reaction. So that's why you're getting this kind of volatility here. And again, relative to those regional banks, I think the game is afoot. I think there are people, I wouldn't say purposely spreading rumors, but trying to agitate things as much as possible, possibly for their own good with credit default swaps and out of the money thing. But yes, it's been range bound, and that is impressive. But I think I'm going to wait for a couple of weeks to see if that holds up.
Thank you, Art. We appreciate the analysis and perspective as always. Happy St. Patrick's Day.